One of the companies I have talked a lot about liking right now is General Motors. The company is just churning out cash, expecting $8 to $10 billion in cash from its auto operations in 2024. The market cap is only 4 to 5 times earnings, just buying back stock like crazy. But one of the things they could do with that cash is move into the electric vehicle market by buying a beaten up electric vehicle company with a great brand. That is Rivian. And I think the time is now for GM to acquire Rivian. Actually, it's Rivian who needs to sell itself to somebody. And I think GM is the natural partner. They have the best balance sheet. They still have cash flow coming in. And they need a brand like this and can actually help Rivian in a number of different ways. So that's what I want to dig into today, is exactly why this deal makes so much sense for GM specifically. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. GM buying Rivian answers a question for both companies. General Motors needs to answer to investors, how are they going to make a transition to electric vehicles? They're trying to electrify a bunch of their vehicles that they're currently making, but they have a few challenges. They've got legacy brands that don't really make sense in the electric vehicle market. Most of their products really aren't all that compelling. They're building some new technology, but it's not clear that their technology is really competitive with a company like Tesla or even Rivian. So buying Rivian actually gets them some of the engineering that Rivian has done to build a custom electric vehicle, whether that's the software stack, the batteries, the motors. GM could pick and choose what it makes sense to put in its vehicles and build off of that R1 and ultimately R2 platform. I think there's a lot of synergies that could potentially happen there, especially on the software side. And for Rivian, GM is the cash that the company needs. Rivian's challenge right now is they're burning almost $5 billion of cash per year trying to build out their Georgia facility, and the cash that they're losing from operations. That was based on their guidance for 2024. If you look at this chart right here, you can see that GM is generating plenty of cash to cover that. The other thing that they could do is you could take the facility in Georgia and just cancel that. GM has enough manufacturing capacity to build Rivian's vehicles in its own facilities. So you wouldn't have to spend billions of dollars to build another production facility. You could just do that within GM's manufacturing capacity. They've also got the capacity for batteries. They've made investments in that side, in chemicals. I just think there's a lot that both Rivian and GM could bring to each other. And that's really the advantage of GM acquiring Rivian at this point. And I think it can't be overstated how much trouble Rivian is currently in. The company has over $4 billion worth of debt on the balance sheet. Like I said, it's burning through cash, and it's not clear that there's demand for the company's vehicles, at least to the scale that they're building out. On the fourth quarter conference call, analysts were asking, hey, are you still committed to building out a new manufacturing facility in Georgia that's going to cost about $5 billion and have 400,000 units of capacity? And management said, well, we don't have to build that 400,000 units of capacity. We've got it basically in 2 phases that we're going to build this out. So great, you can spend $3 billion and build out 200,000 units of capacity, but you still have to spend that cash, and that's cash you simply don't have on the balance sheet. I mentioned that they're going to be basically cash break even when you consider the cash on the balance sheet and then the debt on the balance sheet. They're going to have a net zero cash position by about the end of 2024, based on their guidance that they gave after Q4 2023. So that's just a terrible position to be in. Where are you going to get that cash? You're going to have to go back to sell more stock in the market. That's going to tank your stock price. And the stock price is already down. We're down about 90% from the peak when the company IPO'd. You could issue debt, but you already have about $4 billion worth of debt. So that's not all attractive. You're probably going to get a really terrible interest rate in the current environment, maybe even in the double digits. That's going to be tough to pay back when you're not making a profit on any vehicle that you sell. You can see that this is a really tough position for Rivian to be in. So from a financial perspective, GM brings a lot to the table to Rivian. And I think this would be a really great way for both of these companies to work together. And from GM's perspective, the acquisition price probably wouldn't be all that onerous. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Based on where shares are going to be trading after the market opens on Thursday, Rivian's going to have a market cap of somewhere around $12 billion. They currently have a net cash position of about $5 billion. So the total cash outlay that GM would have to put out is about $7 billion. That is cash that GM has on the balance sheet. You can see that right here. There's over $20 billion in cash on the balance sheet. The company's been using a lot of that to buy back stock, but they could simply transition that to using about $8 billion worth to buy Rivian. Plus, they have the cash flows coming in from the business. So the balance sheet is certainly strong enough to take this kind of an acquisition. Like I mentioned, you could actually cut some of the planned expenses that Rivian has over the next couple of years for some of those capital expenses. You could also reduce a lot of their operating expenses. Rivian is going to have about $3 billion of operating expenses in 2024. You could cut that dramatically because you're going to have a lot of overlap, especially from an engineering and sales side. Now, the question would be, do you want to keep the showrooms and the sales infrastructure that Rivian has? Do you lean on the GM dealer network somehow? This could actually be a really interesting way for GM to get into that direct-to-consumer space and not have to deal with those dealers, but you could also lean on dealers to provide maintenance and things like that. So that's ultimately where dealers make a lot of their money anyways. So you could just tap into that infrastructure instead of having to build it out all on your own the way that Rivian is having to do right now. Same thing with the charging infrastructure. GM has charging deals with 6 or 7 different charging companies, and that just taps into the app in GM's electric vehicles. They're also moving to the NACS standard, just like Rivian is. So again, a lot of what you would call synergies between these two companies from an engineering, from an operational perspective. So I think this just makes more sense than it ever has. The fact that Rivian has gotten to the point where they really seem to be in kind of crisis mode. Their conference call was extremely depressing, and there doesn't seem to be any clear path forward for them, especially if demand for electric vehicles doesn't materialize in the way they need it to ramp up their Georgia facility. They're simply not going to be a profitable company if they're only running the R1 line of vehicles. There's just not that much demand for $70,000, $80,000 vehicles. It's a great product to start with, but that's not how you build a profitable business. If you're Rivian, it's not how their cost structure is built. And for GM, you have a very uncertain future even getting into electric vehicles. So you can cancel maybe some of the vehicles that maybe didn't make a lot of sense. They're already starting to pull back on some of that. So we saw that in late 2023. They're pulling back on the developments that they're doing in electric vehicles and just push that over to Rivian. Now you've got a new brand. This is something that companies have always done in the auto space. You acquire a new brand when it makes sense to move into a new market. So I think this makes a lot of sense. I think GM is the natural buyer. It's a US company. Yes, Ford was involved with making Rivian vehicles, actually made a lot of money from Rivian's IPO. But right now, Ford is kind of a mess from an electric vehicle standpoint, from an operations standpoint. And I think GM makes a ton of sense. In a lot of ways, they need each other. And that's why this deal, I think, is maybe my number one prediction for 2024 in the auto space. But what do you think? Should GM buy Rivian? Should Rivian sell itself to GM? Because it might be forced to do something within the next year or two. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.